Welcome everyone to the Coronavirus Impact Global Conference call, the Post-Pandemic Scenarios for Global Property Markets, presented by the Real Estate Industry Network. This presentation will last approximately 1 hour and there will be time set aside for a question and answer session. During the presentation, please submit your questions via the Q&A box. Please note that this call is being recorded and the recording link will be available approximately 36 hours after the live call upon request. At this time, I would like to pass the floor over to the event champion, Reza Tadley with YPO Pacific.
Hi, everyone. Thank you for joining our call. You know, this is a continuation of a series of the calls that we've been doing to keep our members informed, and especially with the pandemic and where things are going. I hope you and your families are very safe and you're taking good care. We have a great event for you. Our event again called the Post-Pandemic Scenarios for Global Property Markets. Our goal is that you can learn about capital flows, how they will shift in the coming years, and for both in portfolio and direct investments, explore which countries and cities will benefit those are the greatest opportunities and appeal for property sector, and learn what new commercial and residential real estate models are best suited for to future economic demographic conditions. We've had about 450 people registered for this event. We will have a recording of this event also available to our members. We've already collected a survey. We've had about 40 responses with questions. So our speaker is going to address a lot of those questions during the discussion. There'll be a Q&A after this, so feel free, put in your questions. We'll do our best to address any of your questions. Some of your questions may not directly relate to this. Our time is limited. Please keep in mind that we are tracking all these questions, and we'll make sure that they're addressed in upcoming calls. Daria will be, after this, will be sending you a list of our upcoming events, which one is May 6th. It's YPO Around the World, Session 1. On May 7th, we have a bi-weekly event starting with Alliance to End Homelessness. It's a real estate network joint session with our other networks. On May 8th, Real Estate Perspective in Crisis. It's a bi-weekly event. It's been highly in demand. And on May 12th, Mitigating the Risks in Multifamily Real Estate. And then on May 28th, Technology and Innovation in Real Estate. We have quite a few recordings of past calls in different sectors. And I know some of you had questions about how to handle crises in different property categories. A lot of those will be answered in the recordings. Please look for the email that will have all the links for you. There'll be a 30-minute presentation by our speaker, and then after that, we'll do a Q&A. So let me introduce you to a great speaker. I was actually introduced to him by a very good friend, Chris Marlin, president of Lalana International. He's a YPO friend and always very thoughtful, and he's very involved in global initiatives. And he says, Reza, you gotta get Parag to give a talk to YPO. Parag also, did a keynote at the Dubai Edge a couple years back. So Parag Dana, I'll just give you a biography on him. It's very short, but there's so much more. He's a renowned global economic strategist who's advised dozens of leading companies and governments around the world. He's a founder and managing partner of FutureMap, a data and scenario-based strategic advisory firm. He's author of global bestsellers such as Connectography and The Future of Asian, which Charlie Munger, which by the way, I'm a huge fan of Charlie Munger, and he's not an easy guy to be impressed. In the annual meeting of Berkshire Hathaway last year, he called Parag's book a must-read book. Parag holds a PhD from London School of Economics bachelor's and master's degrees from Georgetown University. And also Chuck Hagel, former U.S. Secretary of Defense, said this too about Parag Khanna's scholarship and foresights are world-class and must read for the next president. So we've got a great speaker for us. Thanks, Parag, for being on this call. I know you're busy, and I know right after our call, you got a call at Bloomberg. So thanks so much, and please take it over.
Thank you so much, Reza. Thanks to all of you in the YPO family. I've really enjoyed bonding with you, even though we haven't yet gotten to physically get together, hopefully one day. But I'm delighted, I'm honored to be joining you. I have long admired the YPO network around the world and written very positively about its impact on economies everywhere. So I'm really looking forward to this conversation. I know our time is limited, so I'm going to jump right in and go through these slides relatively quickly. But I'll also note that not only this conversation, but the slides are also yours to keep. I'm happy to schedule follow-ups and make this a longer conversation, because we are going to be in this set of post-pandemic uncertainties for quite a while to come. Let me begin with a global commentary here. Of course, the pandemic proves that we live in a global world. But from an economic standpoint, in many respects, the world has become more and more tripolar. A North American system, a European system, and an Asian system. And you can see that also based on the underlying bubbles that show you the GDP per region, per country in PPP terms. Other than global capital markets and global technology networks, in many ways, you have a strong degree of regional trade integration. Let's remember that this predates the pandemic. The trade war that kicked off a couple of years ago led to a situation where US-Canada trade is north of $300 billion, US-Mexico trade above $300 billion, US-China trade dropping to $270 billion, right? So the North American Union is in many ways happening, even though that's not a phrase that President Trump would necessarily use very eagerly, but it's organically happening. The nearshoring is going to accelerate this as well. Again, that has been a trend that's been underway for some time as well. It has to do with energy, has to do with incentives, has to do with automation. These factors have been driving nearshoring as well. So I can see North America moving towards further integration. Let's remember, we are in a caveat. We're in an extraordinary situation. The US-Canada border is closed. The world's longest border is closed. 25 million people normally cross that border every year. It's going to be probably a lot less this year. But there's blips and there's trends. The trend is this regionalism. The second, European Union context. As you all know, 70% of Europe's trade is internal, but they are right now working to get through this transition from having just a monetary union towards a fiscal union. We've known for at least 12 years, certainly since the last financial crisis, that Europe has needed to match its monetary union with fiscal union, banking union, and so forth. The question is whether they're going to be able to cross that threshold and deepen, that integration. And we're seeing, partially that play out right now. In many ways, the ECB has proven that it will do whatever it takes, so to speak, and is backing so much of the European economic system. We're seeing a pretty large volume of, euro bonds being issued, and so forth. Now, Asia, just to be clear, is the largest of these systems in PPP terms. Asia is 50% of global GDP. It too is increasingly integrated internally in terms of the trade volume. And some of the biggest trade agreements in the world, like the RCEP, were ratified last year and are going to be implemented over the next couple of years. That's going to bring another $200 to $300 billion of internal trade growth. And also now investment, right? FDI and so forth has largely become intra-regional as well because of a range of factors, such as indeed the trade war, protectionism, and so on. So supply chains in this world are moving towards a make where you sell model. You see that American multinationals, even though Trump is saying nearshore, they're saying, well, we still have to make in China the things we sell in China, make in India the things we sell in India. That's the way supply chains are going, again, largely around these regional lines. So that was a global commentary I wanted to make a follow-up point about Asia as it relates to this rebound, because a lot of people have asked, when will we come out of it? And the answer again is more regional than it is global. right? We don't know what the shape of the North American recovery is going to be, but I'll make some comments on some scenarios there, nor Europe. What we can see though in Asia is that because the virus infection rate has gone down, they've been using these contact tracing apps as well, and there's going to be this incremental reopening and usage of immunity passports and so on. You can see that there's a bit of confidence. There's certainly confidence in the markets that Asian markets are going to rebound quickly. So you can see the delta here between Asia versus our traditional MSCI emerging market category. Asia really is an asset class, a very strong asset class unto itself. And one of the other things that's going to happen, which is crucial for thinking about property markets in general across the region, is that there's going to be a big trend towards privatization. The pragmatic governments in this region don't want to, on top of the widening fiscal outlays to cope with the stimulus and current account deficits or budget deficits, they don't want to weaken the economic fundamentals that they've spent so much time strengthening over the last 20 years since the Asian financial crisis. So I predict a wave of privatization that's going to benefit foreign investors looking at the Asian economies. Let's talk about some of these asset classes that I think are strong very globally, because many of them involve real estate and property and land, and obviously technology is a critical one. Everything that promotes connectivity. Globalization may be down, but let's remember connectivity is up. Globalization is the measurement of how much we're utilizing our connectivity capacity, our connective capacity at any given time. Right now, it's low in terms of oil and trade and physical goods, but it's very high in terms of digital data transfer. So the asset classes that are considered obviously essential services, right? And I think these are two critical words that we're all hearing a lot everywhere. Essential services must remain open, non-essential services closed. We may not have thought about where we fall along that spectrum, but now we know. So essential services in the logistics space and delivery are going to be important. Data storage, obviously, everything that promotes peer-to-peer cooperation in work and education, entertainment, mobile finance, all of these, and obviously the data infrastructures around it in terms of data storage, warehousing, data centers, all of that kind of stuff is critical. So obviously, if you're looking at and I'll get to this in a number of other ways, but thinking about how countries are going to want to be more self-sufficient in terms of warehousing and stockpiling of food and all of these other areas, this is a physical reconfiguration of how we live that's coming up. And so the digital asset class is actually a physical thing, and this is something that I've emphasized throughout in my books. All connectivity actually rests on some physical infrastructure. So tracing that connection between what we think of as an untethered kind of digital world and the physical infrastructure indicates where you want to be investing in terms of land. So again, let me make another point. Two words we haven't heard a lot of lately are climate change, but it hasn't gone away. The forest fire season is going to creep up on us in a number of geographies in North America. We're on pace to have another very hot year. Well, the latest data around what's been happening with droughts suggests a sort of continuation of the pattern that we've seen over the last few years. We have the lack of sufficiently rapid investment in climate adaptation in coastal areas. We already know that these geographies are at this point sort of discounted, and this is before the I don't want to say exodus, but certainly the softening, weakening of the commercial real estate market owing to the pandemic and the digitization that I just mentioned coming out of it on the back of it. So it's going to be really important to think about the new geographies of business and where people and workers are going to be. I'm going to spend a fair bit of time on that as we move forward. So let me get into this migration issue. We are at an extraordinary point in human history. We have never artificially, voluntarily, in a coordinated way, stopped human migration. There have been periods of history where migration certainly slowed down rapidly, like during a world war, but not in this global synchronized fashion as we have today. Just before, on the eve of this pandemic, we had reached 1.5 billion international tourist arrivals, close to 300 million expatriates. but suddenly today migration is zero, right? No planes are even flying, basically. So it's really remarkable. So the question I want to pose, and this is such a deeply relevant issue for all of us thinking about the future of our human geography and what it means for land valuation and for property development, is where are people going to go when this ends? Is there a shift from coastal to inland? And as I say here, from red zones to green zones. So again, there's this artificial suppression of migration right now. But what happens when we all have been vaccinated and people say, well, when the next pandemic hits, I don't want to be in this country or city with bad healthcare. I want to move to a place that is much more of a green zone or a blue zone, that's climate safe and that is a good healthcare system and where I'm near a park or whatever the case may be. So this map is actually showing you a forecast of what happens to global agriculture as temperatures rise from up to 4 degrees Celsius above the 1990 baseline. And if we get to that point, we're already on our way there, unfortunately. Global agriculture is wiped out in most of the largest food producing regions of the world today, like Brazil, the US, India, China, and Australia. Instead, agriculture winds up moving north. So that tells you something. Of course, the vast majority of the human population lives in areas that on this map are brown, dark brown, desertified. So very, very problematic scenario. So why do people move? I list those factors on the top there. There are 6 major drivers that motivate people's migration, whether it's domestically or internationally. And what do people look for in terms of where they want to go? I list those on the bottom. So these are things I want everyone to keep in mind, because this is the deepest megatrend you can imagine, is our human response to these external sort of forces like the pandemic. And as this plays out, it's going to affect which cities are populated and which ones become depopulated, which real estate asset classes are worth investing in, which ones are going to be abandoned. It comes down ultimately to humans and what we use and don't use. And by the way, this is critical from a global demographic standpoint. We're at a great inflection point where the world population is basically flattening out. And by the way, this pandemic is going to accelerate that, let's be clear. After the financial crisis of 2008, we experienced a massive decline in global fertility for economic reasons of insecurity. If ever that was happening again, it's right now. So don't expect the world population to ever reach 10 billion people. I doubt that the world population will even reach 9 billion people. So now here we have this built environment, North America, Western Europe, Northeast Asia. Think about, Tokyo and, London, New York, all of our great cities of the Western world, the modern world. Some of them are already depopulating, right? They're being backfilled to some degree. New York, LA are getting backfilled, but Tokyo is not. Its population is actually declining. So countries that are not attracting that next generation, millennials, Generation Z, young families, that means that they're not going to have the investors, the residents, the taxpayers, of the future of the next generation. So you do, in your industry, have to take into account these major structural megatrends. So let me come back really, really quickly. I mentioned the real estate asset classes that are essential versus non-essential. I've listed some of it here for you. I'm going to come back to alternative energy in a moment. But again, food, retail, medical facilities, data centers, right? Critical. Thinking about areas where land is appreciating as a result of either climate variables or because of investor residency schemes, or because they are doing the right things to attract migrants, like affordable housing, retirement colonies, these sorts of things. So I put a graphic here just showing you, the house price index for Canada. It's up. And this tells you something. Now, it's a number of things that drive this. Huge amount of immigration. Canada had 100,000 net migrants more than the United States did last year, right? I don't know if people fully appreciate this, but America has 10 times more people than Canada, but Canada let in 100,000 more people last year than the United States did. And of course, Canada has climate change in a way going for it, as I've written about before. And for those of you who are Canadian, read the Globe and Mail this Saturday. I have the lead essay, and it's about Canada as the new kind of lucky country. But in any case, so lots of thinking around what are the new asset classes to invest in. Health tech is another one. Again, healthcare communities. Obviously, the pharmaceutical industry goes without saying at this point. Which again are the countries that are building sufficient numbers of health clinics. Those are going to attract people as well. Agriculture, absolutely critical. Not typically what you think of as a real estate asset class, but remember that the psychology around local self-sufficiency is already a movement that's been growing and is really going to accelerate on the back of this pandemic, because people are realizing that with Russia banning food export, wheat exports, Vietnam banning rice exports, we need to invest more in the hydroponics and aquaponics, which means urban farming, urban agriculture. And there are countries that are already very strong in this, like Australia, Japan, and others, where these technologies are gaining ground. The United Arab Emirates has just announced another $100 million investment in aquaponics. Singapore has a program called 30 by 2030. They want to have 30% of their staple crop consumption, as well as fish and chicken, poultry, come from fish farms, organic farms, and kind of alternative, plant-based protein facilities. As of last month, they said we need to achieve this goal by 2023, not by 2030. So just think about how much money is going to go into, research, R&D funding, government grants, and subsidies to develop urban agriculture. So this is another asset class to think about. Obviously, again, clean energy, right? So water desalination, alternative and renewable power at a local scale, off-grid power systems, and so forth. All of this is also going to be critical, and a lot of this is in and around our cities, our key geographies. So what does the city look like? And I think, I want to also have everyone remember a couple of key phrases coming out of this. Something that I heard from an Australian client recently was, never before has anyone cared so much what is in their immediate 5-block radius. The phrase 5-block radius, I think everyone should keep in their mind, because that's the space in which we've been, effectively quarantined. So do I have good access to food, coffee, a park to go to, a place to walk my dog, whatever the case may be, because, you could be experiencing rolling, quarantines or whatever the case may be, obviously medical facilities and so on. So what does the ideal 5-block radius look like? And there've been a lot of things going on in the smart city space that do emphasize walkable community, mixed use real estate. That's not new, but the focus on deepening down on that, strengthening that, is obviously going to be really paramount moving forward in order to retain people who might otherwise leave for cheaper environments coming out of this pandemic. So a lot of technology has to go into it, obviously. A lot of new investment, a lot of conveniences have to be put into spaces so that people are going to be willing to stay and not move away to other places. So this is the smart city has to also be, have the conveniences, but also has to be affordable. Let's remember, the urban wage premium has been declining, right? So a lot of, property markets have been, premised or thrived on people spending a lot, being able to afford high rent in cities. That's not the case anymore. And the digitization is this exogenous kind of, or lateral factor that's going to, draw people away from cities. So cities are going to be competing with suburbs to some degree. So I make this point here. As it is, I mentioned you have had a bit of an exodus away from the big cities like LA, like New York, Tokyo, and so forth, because they've just been so expensive. So you can see that what's going on the right-hand side there. You've got the technology factor that's being used in suburbs to deliver goods. So this is the Starship. This is an Estonian company. They have a very cute set of robots that are around in Fairfax, Virginia, delivering goods. Drone delivery as well. Again, a number of these trends predate the pandemic, but will certainly accelerate in its wake. So thinking about these technological variables, allowing people to disperse a bit more and yet still have conveniences. So think about autonomous vehicles, obviously, as well, diminishing that sense that suburbia is too far away. Now it becomes this case of people saying, you know, if I'm going to be quarantined or on lockdown, I want to be in a spacious, you know, sort of an environment. And let's also remember one of the things that's reinforcing May is this generational wealth transfer in North America, in Europe. So younger generation is inheriting, you know, landed assets, property from an older generation, and you know, may not be able to afford to simply sell off that asset. They may move into it. You've got young people moving back in with their parents right now in the same way that they did after the financial crisis. 12 years ago, it was millennials doing it. Now it's Generation Z having to do it. It took a while to get those people, you know, youth off the couch, so to speak, and back into their own independent rentals and trying to save money for home ownership. Same phenomenon, again, devastating that capacity. So, and again, that dovetails with what I'm calling here the ecopolis, you know, sort of movement, this idea that we want to have more self-sufficient sort of communities, you know, circular economies, renewable energy, and so forth. So think about how you can be building and developing these sustainable, localized, affordable kinds of communities that don't rely on global supply chains that we've taken for granted over the past couple of generations. Who's going to pay for all of this? Well, I make a point here about, you know, public capital, public assets. It's very important to think about how, you know, the public-private partnerships, the ways in which there needs to be almost a liberation of land and a deregulation in many ways of public assets, so that some of the critical asset classes like the hospitals and the co-living spaces, affordable housing, can be developed in cities. Otherwise, people may start to move away from them. And just to emphasize, I've written so much about urbanization, you know, over the years. So it's very ironic in some ways for me to be pointing to de-urbanization. Just another piece this weekend in Politico, I have a long piece about kind of the coming de-urbanization that the pandemic may cause. It's a scenario, but there is data to back it up. So I think it's more than just a thought experiment, let's say. And I think that, you know, is in the private sector, you'll obviously have to be working very closely with governments to identify or to shape, in many ways, the priorities around what future land assets are made available, what the cost is, what the priorities are, and try and nudge in the direction of some of these more kind of secular trends that I've been talking about. So I'm going to pause right there. I tried to keep it, you know, relatively tight because I know there's a lot of questions that you're going to have. So I'm looking forward to discussing all of them with you. Thanks very much.
Thanks, Greg. You know, one of the things that you and I talked about before the call, you were mentioning about it would be a while for us to get on international travel, and you know, when you talk to different groups, some are saying, "Oh, this will blow over quickly, and we'll go back to the normal way of doing things." And from what I'm hearing you say is, you're actually revisiting your own assumption about urbanization, and you're seeing this as a major potential shift. What can you talk a little bit about, you know, your thoughts on your comment about, you know, there seems to be two groups. One group say we'll go back to the same thing, and some that say this is a major shift.
So we can go back to the same thing in certain habits, right? So, you know, then if we all have a vaccine, then, you know, if there's going to be, you know, the next LA Rams game, you're going to be there, right? So, you know, some habits will go back to, and we'll be able to go back to, you know, and it won't be a big deal, right? You know, we've graduated through and survived previous, you know, pandemics, obviously, to get to where we are today. But we cannot forget the fundamentals around the cost, right? We have a finite world population, not an infinite world population. And much of that population is younger people who cannot afford, in a way, their savings rate is low. They're not having children, so they'll save money by not having children, I suppose. That's not a good thing for the planetary population. So this idea that society just replenishes itself in each place is not true. Instead, the big shift, you know, to me is the global war for talent, right? The global war to attract people. And therefore, the degree to which young people are mercenary and willing to go anywhere where there's a job or where they can afford to live and have a decent quality of life, that's a pretty big psychological shift. And it does point to, again, cross-cutting themes. On the one hand, it's sort of, there's still an aspiration that many people may have to live in San Francisco, LA, or New York. But what we started to see already quite strongly before the pandemic struck was that people are saying, can I take this job in Austin or Pittsburgh or Denver or whatever the case may be. I think the remote worker is the remote software developer is, perhaps the big winner in many ways from this pandemic, because that person really wasn't going to the headquarters anyway, didn't want to go, wanted to work from home, didn't want to pay such high rent in, downtown San Francisco or whatever. And now, after months of being, working remotely, that person gets to say, told you so, and they get to move to Idaho, or Wyoming, places that are cheap and plenty of fresh air, and they can charge, as much or more for their services. They can also have global customers, because I'm talking to clients in, in various corners of the world, and they're saying that they're not going to come back to the same headcount that they were at before. Instead, they're just going to hire remote teams on a project basis that can be anywhere in the world. So the person, the remote talent, if you will, is going to be the winner. And those people had already begun to say quite some time ago, living in a shoebox is not worth it. So I think, again, there are multiple conflicting trends here. So do cities still matter? Obviously, right? I think it's in our human nature to want to convene physically. That's what, connectography to some degree was about. And the megacity, I was sort of celebrating or saying, this is one embodiment of it, but we don't all actually live in megacities in Asia with 50 million people, right? And there is, given the climate change factors, let's not forget, and the competition to lure talent, you've got within the United States, Vermont and Oklahoma saying, we'll put $10,000 in your pocket if you'll come and move here and be a digital worker working somewhere else, right? So there's a competition. You've got the highly skilled migrant programs of a place like Canada. The UK is trying to create its own Canadian style kind of thing, a big competition to lure people in, based on the lower density and affordability and quality of life. And again, lots of places that offer decent quality of life in a post-pandemic world competing for a finite number of people. And so there is going to be obviously winners and losers in this. So some cities may win, some cities may lose.
And Parag, we had a number of questions that came in that they were asking about, which cities are, we have a pretty international audience, which ones would you avoid, which markets, like let's say you go through Australia, Asia, Africa, North America, South America, Europe, what, if you were to advise, what are the top maybe 5 areas, or which areas you would avoid, which areas you would go into as an investor? Any thoughts?
Well, the thing is, for the way I look at every place, there's pros and there's cons and there's scenarios really around what path they take. So if you think about the commodities, export dependent economies, countries ranging from Brazil to Russia to, the Gulf countries and so forth, they're in a serious amount of trouble, because it's not only about the peak oil demand that we were already at, it's about a collapse really in oil demand and the competition from renewables. So those countries now really can't sustain their spending, and they're going to have to massively rein in their spending. And so they're going to have a hard time remaining as attractive. They may have to start to raise taxes and so forth. So I think that some of these, so even when a place seems like a climate oasis, that doesn't mean it's going to be an attractive place to live. So, there's pros and cons to every geography. I'm looking, in particular in the project called Climate Oases, I'm looking at the sort of more northern latitudes of the world. I'm looking at places where land valuations are underpriced versus their climate forecast, because we have fairly detailed climate assessments for every sort of latitudinal, longitudinal intersection in the world. And obviously the northern hemisphere sort of is the winner from climate change, or the more northern parts of it. And yet you find that this has not yet been priced in. And so I'm looking at 80 to 90 variables. Again, you think about what I was saying before about all the different boxes you want to tick to be a attractive green zone or blue zone in terms of affordability, fresh water supply, digital connectivity, friendliness to immigration, all of these kinds of factors that tick a lot of these boxes. It's not just pandemic or not pandemic, again, the fiscal health of the country, all of you people should be taking these things into account. So I give this simple example of Singapore, where I live right now. They have one of the world's 2 or 3 largest sovereign wealth, pools of capital, and they've been able to write $100 billion check in just the last few weeks and say, hey, everyone gets paid. Don't worry, just stay at home for another month or two. And, I know that a couple of years from now, taxes are not going to go up, right? The government can afford it, has this rainy day, pool of cash. And not every country obviously has that, right? But I hope that it's in the back of any investor's mind. If I go somewhere, what happens if there's another rainy day? Is this country prepared to bail out industry, support my investment, and so forth? Or is this a place from which people are going to emigrate? So again, what are the green zones? What are the blue zones? And Singapore doesn't appear to be a winner from climate change, but it's certainly a place that's has very strong public policy. So to be honest, I'd love to hear sort of specific places that people want to know what's my assessment. But we're actually running a global model right now, looking at so many geographies and trying to identify the 30 or 40 places that offer the kind of most substantial resilience against all of the potential sort of threats.
Probably one of the other questions we just got was, what's your assessment? How does the next 18 months look?
Right.
Given what we're going through.
Yeah. So I think, I said this at the beginning, but I want to emphasize one point initially in answering, which is that it's going to be very incremental, sequential, and regional, right? So, to the extent that there is an opening in terms of travel, cross-border mobility, and so forth, no question that it is not going to be a global, simultaneous, and large-scale opening, right? It's in many ways the antithesis of those things. So incremental, regional, probably quite slow. So that's one thing. The other is from a macroeconomic standpoint, as I said as well, there's this North American trajectory, European trajectory, Asian trajectory, largely decoupled in many ways from each other, a tripolar decoupling. There'll be a North American path, a European path, and an Asian path. And they're going to be quite different from each other because they're handling the virus and handling the kind of reopening very, very differently in these 3 different kinds of societies and geographies. And from the market standpoint, this can only be seen as a W kind of, at best sort of recovery, an unpredictable and very wobbly W, because right now, obviously, we see the divergence between the stock market and the real economy. This happened as well in 2009. The fundamentals, though, are not even necessarily as strong. Or at least the pain that this crisis has caused is worse than 2009 to a large degree. Therefore, one should expect a contraction again as the kind of non-correlation starts to bite. The stimulus runs out and so forth. So you'll have another wave of business failure, bankruptcies, and so forth. But then you'll have consolidation in different industries in the market, and you'll start to have some companies pick up again. And so on. So it's going to be, and then you could have another wave, obviously, of the pandemic and so forth until we have a vaccine, these rolling closures. So definitely a very wobbly kind of W shape over the next, 12 to 18 months.
We have also a number of questions regarding property sectors and different sectors like hospitality, office, with all this happening. The impacts you see, and you can maybe talk about residential and other food groups.
Yeah. So just, hospitality assets, I've been on a number of calls, related to this in the last few weeks. And, we're talking about a very long time, at least by industry standards, with incredibly low occupancy, right? And so that means one has to think about mothballing certain assets, converting assets into different kinds of facilities, different sort of housing facilities or something like that, and working with governments around that if that's possible. You have an end homelessness initiative. You could take a lot of hotels and convert them into affordable housing, probably, and get a subsidy for that. That's the kind of thing I would be thinking at this point, because you're talking about massive underutilization of these kinds of assets for quite a while to come. So it may seem like a radical idea, but it's also kind of logical at some level, given the depth of this crisis. I've been talking to big, tour operators. Look at what's happening in the tourism industry, how many jobs are being lost, even in the booking companies that are digital and global and kind of lean. Huge cuts there as well. And again, that reopening will be largely a regional or even national. A Chinese holiday is beginning right now for the next 5 days. 85% of Chinese travelers, if not higher, are staying in the country. So all of the Asian countries that have been accustomed to receiving this wave of Chinese tourists over these intermittent sort of holidays are not going to get them, and that may last for some time. So I think there's going to need to be some real reinvention there. Again, in terms of a property, I'd be thinking about these sort of peri-urban, ex-urban, suburban kinds of enclaves, and the ways in which they can be serviced through sort of more convenient transportation systems. So ride sharing, obviously, but the whole walkable micro community where sort of middle class remote digital workers can sort of be and that kind of thing is going to be what people are looking for moving forward, and that I think is potentially going to last quite a long time. So I think there's I could go on and on, but I think that those are some of the underlying trends to be looking at.
One of the other questions we had was also regarding the what's happening in the oil and gas market, the crash there, and impacting economies that are dependent on oil. Markets like Canada, like areas like Texas, Houston, or countries that are dependent. Do you have any thoughts on that?
So it was commodities, right?
Right.
Yeah. So as I mentioned, the commodities exporters are in big trouble, obviously, right now, because the irony is when it comes to metals, minerals, oil and gas, those countries are in a lot of trouble. If you think about, take a place like Australia, you have many sort of, it's like a triple whammy, quadruple whammy, because you've had the bushfires last year, almost choking and closing off Sydney. Then you've got again overpriced a property in that city, climate change being a factor. Now you have the virus, obviously, the downturn in commodities exports, and then the lack of immigration, because of course the property sector in Australia relies heavily on foreign investment from China, Korea, Japan, and so forth. So pretty much everything is hitting them all at once, right? And they haven't been prepared for that. So even rich countries that are commodities dependent face that struggle. It leads to a point, more broadly about commercial real estate, obviously, that we've touched on, but need to deepen on. Again, it's not that we'll never go back into tall buildings, right? I remember after 9/11, people said we'll never go back into tall buildings, but of course we've all gone back into tall buildings, and we've built a lot more tall buildings. However, what's different this time is, again, occupancy was declining to some degree in tier 1 cities. And that is, as a result of this, what I'm hearing out of Tokyo, Singapore and elsewhere, is that people are going to distribute teams, into less expensive areas, be permanently remote, and so on. And therefore, you're going to see many of these leases being broken. And I think that is really a fairly long-term thing. So one has to think about the conversion, of some of those assets as well.
Great. And Parag, what are your thoughts on the coast of areas like coastal areas like in the U.S. and Florida, let's say, or California, or other coastal markets for investments?
Right. So, I had that slide showing, what's happening in terms of the, the structural decline, let's say, of insurability of those assets. Obviously, it's a phenomenon that all of you are familiar with. So, in the medium term, especially because, climate change is a public goods issue. We don't have collective action. We're not reversing it. So, one can't be sanguine about, those coastal, areas right now, especially once the insurance markets get much more active in denying, sort of property insurance to those investments, or even the access to credit to build in those areas. So again, part of what we're doing with Climate Oases is starting to say, what are the new geographies that people are going to start to go to? Inland, Colorado, Georgia, Minnesota, in the US, and equivalents in other parts of the world that are more attractive from a climate change kind of standpoint. And I do think that there will be this sort of, again, this inward migration, this resorting of the population, because it's happening at the intersection of climate change, post-pandemic paranoia. So climate change, pandemic paranoia, and economic crisis, right? These three things together do not allow anyone to be just complacent, to say, well, I'll just stay here, right? That's just not how it works, right? People get up and move because of the combination of these things. So, they're going to be looking for affordable places that are more, inland rather than coastal.
Correct. There's a number of questions. We've got a lot of questions, but just kind of summarizing it, it seems like people are concerned that with all this government printing of money around the world, so everyone's printing money, everyone's doing, and then you also have some countries that don't have the ability to print and don't have the currency. Can you give a little insight on, like, are we headed for massive inflation? How is it going to impact companies who have the ability to print and some countries who are not able to print?
Right. So, we're all familiar with the term sort of stagflation, right? And some people are expecting something like that given what's happening with global monetary policy. So on the one hand, you have, more than half the countries in the world have reached out to the IMF for emergency credit lines. And there's going to be the sort of volume of sovereign debt. Also, corporate debt was worrying, prior to this pandemic. Think about where it is now. So we're at a global debt to GDP that's going to reach 300 or something percent. So a number of economies are going to have to massively, you could have obviously the traditional pattern, which is, rising sovereign debt, inability to service it, creditors losing appetite, austerity, restructuring, governments fall, political collapse. So you can expect this in any number of emerging markets that, just hasn't played out yet, whether it's Argentina. Well, in Argentina, it plays out all the time, just cyclically, or, Turkey, maybe even, again, some of the petro states that are not, sufficiently hedged or diversified. So, the South Africas of the world, again, Brazil and so forth. A lot of worries about those economies moving forward, because again, investors are no longer really that interested in a low rate environment of endlessly buying sovereign debt, right? They're better off taking equity in other markets. So, I think that for those countries, it's very problematic. But in terms of inflation, the truth is that just because it's so hard to forecast a really strong return of demand, and because technology continues to race ahead and make everything, cheaper than ever, we've managed to beat the inflation problem despite very loose monetary policy over the last, sort of decade plus. So there's other factors than just the traditional kind of, correlations at play here. So I'm not at this point particularly concerned about inflation.
Even with the fact that a lot of the manufacturing is going to change, like distributions and the way we, like, let's say US is bringing things back from China.
So yes, there is some nearshoring, and this is a phenomenon I've been tracking for a very long time, rather the debate about it. And as I said at the very beginning, we're moving towards a make where you sell world, right? So yes, every iPhone, iPad, or other electronic gadget could hypothetically be made in the United States, you know, in a Foxconn plant in Texas or Michigan or whatever through automated labor. So therefore, the price of that, you know, production is actually not necessarily going to be very high. So, you know, our wages are very high, and high wages are precisely one of the key motivations behind accelerating automation. So in countries like Korea, Singapore, Japan, Germany, Sweden, places with a high, what's called robot density, those countries are going to accelerate automation, and that's actually going to keep the cost of production down. So, you know, the burden actually falls more and more on the public sector to provide for, you know, worker training and so forth, because the private sector just is not going to need as much human labor.
Park, I'm getting some questions on like any specific comments on markets like Mexico and New Zealand. Any thoughts in terms of investments there?
Well, let's remember that, you know, let's take a place like New Zealand, which, you know, has the, you know, reputation and the reality in many ways of being a sort of climate oasis. But let's remember that they've also, you know, changed their laws in the last couple of years to prohibit these, you know, foreign real estate speculation, which had really taken off. And it had led to a domestic backlash about rising prices in housing markets because of foreign speculators, and they have terminated that policy, which should have, you know, allowed people to get residency, you know, if they buy property. And now only 1 or 2 countries in the world have their citizens approved to be able to buy land and to buy real estate in New Zealand, right? So plenty of people can rent, but you can't buy. So, you know, we're going to see shifts in policies in the name of either protecting one's natural assets, preventing foreign takeovers, you know, or having, again, stoking speculation in the market. So that's the New Zealand phenomenon. It's a good problem to have if demand is so high to invest in your market that you have to, you know, significantly restrict it. But it's certainly an important political factor. You know, Mexico, I'm not as familiar with property markets, but from the industrial standpoint, there's no question that Mexico continues to be a winner from the phenomenon that really kicked off with the, you know, just in general, the nearshoring or the offshoring of the American automotive sector to Mexico. And with the new USMCA trade agreement provisions, Mexico continues to benefit quite strongly. Now, also, if you don't have emigration as much from Mexico to the United States, but you actually have a fair bit of immigration of Mexican American dual nationals, American retirees coming down to Mexico, there's opportunities there in the industrial asset class, logistics, and indeed in housing. And Mexico has handled the coronavirus well. You know, you could imagine tourism being quite strong as well. So I think Mexico overall, you know, has a fair bit going for it, actually.
How about India?
Well, so, you know, India's, you know, very tricky because we don't really know if this luck is going to run out or not in terms of being able to more or less, you know, have the virus bypass it, you know, the strong lockdown, you know, being successful or not. You know, so not quite clear yet. So far, so good, but the lockdown has been devastating, even though, you know, economically, even though they haven't had many cases of the virus. So it's sort of a devil's, you know, bargain, if you will. But as we know that, you know, credit to real estate has been a huge, you know, winner over the last decade, you know, or half decade, because obviously their currencies hit rock bottom. The banking sector has been in turmoil, one of the last areas to be properly reformed in the country. So, you know, the property developers have been desperate, you know, for credit. So, you know, lending in that category has had, you know, very, very high yield. That's going to continue for some time to come. Now the currency's only gotten weaker, obviously, as a result of the pandemic. I think, you know, on the one hand, the Modi government has been positive on huge infrastructure investment. So you're generating growth in more provincial areas. That's been really, really important to sort of distribute economic growth. But on the other hand, you know, obviously there's a lot of tensions domestically, culturally, with the kind of ethno-nationalist politics. And now, again, with the pandemic, they also haven't been able to create nearly enough jobs in industry. Software and services are a huge driver of the economy, but even there, you haven't seen nearly enough job creation. So India is really, quite frankly, a mixed picture. And again, climate change, right? The air pollution in Delhi, people moving away from those cities. Surveys within India show a very large north to south migration. So even North Indians, people like myself, for example, moving, en masse to southern states because the climate is more livable. There's been more job creation. The tech centers are down in South India and so on. But there's resentment there as well. Mumbai has a big climate problem. It's sinking due to subsidence. They have to build so much more sort of onshore. It's a bit of a kind of an island archipelago almost. So they have to, just huge structural issues around land development are needed in the country. They have to retrofit all their existing cities, build new cities. So they couldn't possibly invest enough, even though they're investing a lot in the kind of, spatial reorganization of India. And that's going to be a messy process under the best of circumstances.
Parag, we have 2 more minutes left for our call, and I want to keep it on time, especially since you got the interview coming up with Bloomberg. Any parting thoughts? I know you advise a lot of big international funds and real estate funds investing. Any parting thoughts or advice for our members?
I do work a lot with the long money, if you will, because I think that this is a time to think long-term and holistically about how to integrate these various trends. You cannot treat the world as if the pandemic is the only factor, right? Because there were these issues around restructuring of supply chains, demographic shifts, again, the plateauing of the world population, the focusing on the generational change, the preferences of young people in terms of lifestyle and geography. Obviously, taking into account the role of technology and the ways in which that allows us to not necessarily have to be in one place. So many of these variables have to come together to create a reliable long-term picture. But it certainly points to, again, away from the coastal areas, more inland, less high-rise, more mixed use, more kind of, multi-family rather than individual, other than in the case of what I was saying about, the potential return to suburbia, where people are either inheriting those assets or buying them cheap as their values have come really down since the financial crisis. So, a lot of, and then plus again, policies, right? The countries that are really implementing credible long-term policies around trying to attract foreign investment and setting up those very reliable, special economic zones or, single investment windows that are transparent, non-corrupt. A lot of countries are moving in that direction as well. Then, investor residency schemes, more than 100 countries have them right now. This is the magnitude and the range and the complexity of variables that you have to properly, paint a picture of and look at each geography and where they score on these to determine where you should be investing. But that's what I think smart long-term investors should be doing right now. And it may take you in directions that you didn't think that you were interested in, but that are going to be the safer bets for 10, 20 years from now.
Well, Parag, you gave us a lot of things to think about, a lot of great information, and I hope we can maybe in the next few months have you come back and do another call with you.
Why not?
Dive in a little bit more in detail. Thank you so much for being a great resource and giving us all the information and giving. And we wish you and your family all the best and lots of good health. And I want to also thank Daria and Anna from YPO. They've been incredibly supportive of us with these calls. And I want to thank our members for being on the call. And please look for emails with updates I mentioned at the beginning of the call. Thank you all. And Parag, thank you so much.
Thank you, Reza. It was a real pleasure. Thank you all so much.
Take care. Bye-bye.
Thanks everyone for joining. A reminder that the recording will be available within 36 hours after the call's conclusion, and you will get a survey within the next day, a 1-question survey for us to be able to maintain the high quality of the educational content. Thanks everyone for joining. Have a great morning, afternoon, and evening, everyone. This concludes our call.